Welcome to another episode of the Michael Yardney podcast. Today is another one of our popular question and answer shows, but it's a little bit different because it's the replay of a recent webinar where Ken Race, Brett Warren and I answered a wide range of questions asked by the participants. We had almost 2,000 people register for the webinar. It was very popular. However, I thought I'd share it with you, my wider audience who listens to this podcast. And considering the wide range of questions, I'm sure there's going to be something in it for you. For example, we answered questions about why the Melbourne property market is currently underperforming and when to expect it to turn around. As you can imagine, there were a number of questions regarding land tax and what to do about that. We talked about rentvesting, where the best place to invest in Australia is at the moment. Boy, a lot of people asked that sort of question. We talked about ownership structures and much, much more. Now, this session lasts about an hour. It's a little bit longer than the normal Michael Yardney podcast, but as you can imagine, it gave us the opportunity to get through a lot of content. And I'm sure as a property investor or somebody who's interested in real estate, you're going to get a lot of benefit from listening to today's show. So let's get on with it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Let's start things off. We'll do a round robin situation. Michael, the first question is about Melbourne property market. So I'm probably suggesting you're the best person to answer this one.
I'll try.
It's Bock in Mentone. I own a number of properties in Melbourne. I think you'd probably consider our investment grade, but with Melbourne property market underperforming in the last couple of years, why is this so? When will it pick up? And like many investors, I'm wondering if it's worth holding them. I mean, the rest of the market around the country's gone up in value, but poor old Melbourne struggled, hasn't it, Michael?
It definitely has. So let's be blunt. The Melbourne market has been flat for this last 12 months and is likely to remain around these sort of levels for a little while longer. But if you go back over the long term, Brett and viewers, it's been the strongest performing housing market over the last 4 decades. But house prices have been flat despite what many would consider really, really strong population growth due to immigration. And why? Well, I think Victoria's experienced significant economic setbacks, particularly evident the fact that last year, 7,600 small businesses closed in Australia, in Victoria, according to the Australian Bureau of Statistics. In contrast, Brett, where you are, Queensland saw the greatest net increase in businesses, expanding by 11,000 businesses in the same period. Now, why is this happening? Well, one of the main reasons still is the aftermath of the state's extensive lockdowns. I remember 260 days of lockdowns, and some businesses got through initially, but many just were not able to recover. I mean, just walk down the once vibrant Chapel Street and you can see the fallout. So businesses are having trouble. And on top of that, our government, which has run out of money, the Victorian government, has increased payroll tax levies, targeting businesses with payrolls over $10 million. They've also taxed property investors in various ways. And I believe property investors are getting a bit disillusioned with Melbourne. Now, I believe it creates a window of opportunity, but they are abandoning Melbourne. There's recently some stricter residential tenancy legislation and higher land tax. Now, I bet you there's going to be a question on land tax, so let me just put that aside for a second. But let me explain that, yes, there are increased minimum standards for residential properties. Yes, it's harder to increase your rents more than once a year, but it's a short-term economic issue, and it reminds me very much of the early 90s when you were still young and at school, probably, Brett. No, you weren't really, but Ken will remember well the joke that we used to say about Victoria: the last person to leave Victoria turned the lights out. And then the market turned when there was a change of government and when sentiment turned. So despite the current struggles, many of us seeing significant opportunities in the Melbourne property market. Prices are so low below replacement cost at the moment. Melbourne prices are so much different to Sydney prices. The differential hasn't been like that for a long time. Similar to Brisbane and Perth, where property prices have gone up so much more than Melbourne. I think it's sort of in the cycle where Brisbane and Perth were about 3 years ago. Back then, those cities were experiencing the end of a period of strong underperformance, and that was then improved. So you can outperform the Melbourne market, but I think, and in not just me, Shane Oliver from AMP, Dr. Andrew Wilson, Stuart Weems, all the experts I'm speaking to see a great window of opportunity when there's a couple of rate cuts and confidence returns. Melbourne will turn around. Just remember what happened in 2019 and then again in 2020 once market sentiment turned after COVID slowed things down a bit. Suddenly buyers come back. There aren't many properties in the market and the market fires, Brett.
Yeah, look, I think also, Michael, you make some really good points. The people that have, I guess the doors are open again now, right? Everybody's coming back to Melbourne. But just like we kind of saw with Ken in Sydney, people don't, I guess, buy homes when they first move here. They want to know where they're going to live and what they're going to do. So generally that takes a year or two to work that out and understand where they want to be. And I agree. I think the trigger may even be that opportunity when rates come back a little bit, that people will be settled and they'll want to buy property. And again, considering rents are skyrocketing as well, I think that's very, very likely to happen.
Yes, well, rents are, because we're just not building enough accommodation around Australia, but particularly in Melbourne, Brett.
Thanks, Michael. Change of pace for you, Ken, from Gabrielle S. If building an investment property, can you claim the interest on drawn down funds during construction as a tax deduction once the property is rented out, or does this form part of the cost-based expenses you can claim to reduce capital gains? So you're getting mixed claims there, Ken. Any feedback or thoughts from your end?
Yep, there's a couple of different things. I think we need to differentiate between the cost of buying the initial property, which now with changes to the legislation during construction you can't claim, versus the additional borrowing to construct. And that, if correctly set up and managed by your accountant, can be claimed during the construction period. Whereas the interest that you're paying on the initial purchase, you would capitalise and add to the cost base.
I think one of the things I'm noticing a lot, Brett and Ken, is that a lot of people are getting interested in property development. They always have been. But at the moment, especially in Melbourne, where the market's a bit flat, they're wanting to outperform the market by manufacturing capital growth. And there's lots of opportunities in that area. But Ken, there's also quite a lot of stumbling blocks. People don't understand the tax implications, especially GST. They didn't even realise, hey, I've got to pay GST if I do a development, especially if I want to sell it. And a lot want to get involved in joint ventures. And that seems to open up a whole potential can of worms, Ken.
Correct. And there's some very, smart strategies that allow you to develop, can I call it in joint venture with somebody else? So obviously you have to feel comfortable with that person. Whether they say blood is thicker than water, but not necessarily. So putting that aside, we help a lot of clients in joint ventures where they want to take the advantage of the manufactured equity but can't afford a whole development. Call it 2 duplexes or 2 individual sites on a duplex. So they want to work together. And the problem with that is you each individually own half of the other person's as well as half of yours. So friendship finally wanes and you say, no, I'm not going to have any more of Ken. I want to split. And if you do that, the ATO treats it as a tax. So on the profits, the difference between construction costs and market value, GST, because it's seen as a sale of a new residential property for the first time. And for most of the state governments, or not for most, for some of the state governments, they would see it as a change of title, which means a change of stamp duty. So depending on the state, you can get around stamp duty. And because the tax and the GST is a federal tax, in all the states, you can get out of that when you split and walk away with your individual ones. But that means the paperwork has to be correct in the beginning. You've got to have it properly set up. But those taxes equate to nearly 20% of the end value of a property. That's like a deposit. Yeah. So there's significant dollars to be saved and taxes to be avoided if you do it correctly. And just to finish off, that actually can help people who are into a development where they have mixed intentions. I want to build 2, keep 1 and sell 1. So again, there's different strategies you can do to greatly reduce the tax on the one you sell and improve the equity position on the one you keep. But ask first, seek advice, because that documentation has to be put in place before you exchange contracts on the purchase.
Well, Ken, I know you've been helping our clients with that for well over 20 years, and you've helped my children where 2 of my siblings have done one development together, different 2 have done a different one together. So it makes a big, big difference. But again, we'll give people the ability to have a chat with you. I'll show them how to do that a bit later on. Brett, I'm going to just interrupt for a sec because I want to ask you a question because Bill left a good question. And Bill, it's a bit long, so if you don't mind, I'm going to shorten it. But what you asked is, as a landlord, how do you protect your property from terrible tenants and recalcitrant property managers? I'm sorry, Bill, it sounds like you've had some problems there. The combination of these two, we're losing 10,000 or tens of thousands a month on repairs every few years. We're slowly selling down our portfolio because we've got no support from property managers or NCAT. Clearly, you've had some troubles, Ken. I apologise, Bill. So you're asking Brett, what do? We run the risk of losing a lot of money with this.
It's a tough one, isn't it? Especially with those kinds of things. You know, like you said, Michael, land tax and regulations certainly going one way. It does make it difficult. Look, I guess the first thing to understand, Bill, is to really, I guess, buy in those more affluent locations and target higher affluent tenants. Those type of tenants are generally, you know, they've got full-time jobs. They're not unemployed or sitting at home, you know, ruining or the place or whatever. But, you know, it's important to kind of target those more affluent locations. That way they can keep paying rent, they're not falling behind, and they're out and about. The other thing is, I guess, to understand also, Michael, that we're starting to see as well, people don't necessarily rent just because they can't afford to buy or because they're poor. We're seeing more people rentvest more than ever, and particularly the next generation. They're choosing to live where the action is. They don't want to keep moving further and further out. There's people that are getting divorced and separated more than ever. We've seen a huge amount of people moving interstate, you know, getting new jobs and getting married and things like that as well. So there's many, many different reasons that people invest, but getting into those areas that are more affluent, there's really undersupply of those good quality tenanted properties as well that they're trying to find as well. Because I guess that recent survey from PropTrack also suggested that, you know, more people, certainly more affluent people, are renting today as well. Probably a bit late for Bill with some of those things, but Bill, my recommendation also is to don't forget to find a really, really good property manager and do your homework on that. A lot of property managers are just kind of tacked onto a sales office as a bit of an afterthought. They're not keeping maintenance on the property. They're not keeping upkeep on the property. We're moving into a time where the market will probably settle a little bit. Might be a really, really good time to add value. And if you've got an opportunity to have a property manager that can kind of pick those times and help you do those types of things, you can upgrade and keep a good tenant and keep the property in great condition, so you're not having to do these niggly little things every now and again.
Probably one more thing, Brett, too, is landlord insurance. It's surprising how many people don't have that. And many of the malicious damage, if I can call it that would be caused by tenants, is more likely covered. So don't forget about landlord insurance.
Good point, Ken. Good point. That's our first round, Robin. Guys who are listening and girls who are listening, don't forget in the Q&A there where we're going to mention and ask a couple of questions at the end. I can see Ashley and Gagan and Cal and Anna's put a few questions in there already, so that's fantastic. We'll start to work on those. Michael, you did mention land tax before. Let's get into that because that's a hotly thought process at the moment. We've got a question here from Grant Davis, who's having a large amount of property in Queensland and just working out where to invest now because they're hoping for more cash flow and higher yields, but they want to keep in mind that tax effectiveness. And they're starting to wonder if it's worth, still investing in houses with good land content rather than maybe going for units or townhouses. What are your thoughts on the process, Michael?
Okay. Well, first of all, thank you for all the people putting their comments in the chat box. And hello, Frank. I can see Frank, who's a client from way, way back. I remember you well there. So thanks for all the people, the hundreds of people who are online at the moment. The question of land tax comes up a lot. And I've got Grant's question in front of me as well. And he wonders, what should he do about all this? Let me remind you that Victoria changed its land tax threshold, lowering it so almost everyone pays land tax for investment properties, not on your home. Queensland tried changing the land tax a year or two ago, couldn't. New South Wales has capped its threshold. Each state is going to keep changing things. So don't swap from one state to another because of land tax. Land tax is actually tax deductible. It's the only tax that is. It's a cost of doing business. It is a nuisance. I don't like the government taking more money from me than it needs to, but I've just learned to accept it. I remember many years ago when I was doing a seminar with Ken at the Wesley Centre in Sydney. It was maybe 15 years ago. Somebody came to the front of the room and said to me, I'm going to sell up my properties in Sydney because I'm paying too much land tax. And I said, how much are you paying? And I think she said $10,000. Remember, that was 18, 20 years ago. And I said, how much have your property gone up in value? And she said, a lot. And she gave me the figures a long time ago. I don't remember. Now, I advised her, look how much money you've made out of the properties. It's just a cost of doing business. I never saw the lady again, but if she took my advice, her properties would have doubled in value and doubled again in value. And yes, she would have paid $10,000, $15,000 a year land tax, and she may have made it as a tax deduction. But whoever owned those properties has made millions of dollars in Sydney, and the land tax is just a nuisance thing. So to answer your question, Grant, yes, it's a shame when you thought you'd worked out your budgets and things didn't work, and you're asking, should you buy units, townhouses that don't have as much land component? What we do at Metropole when we sit down with clients is run numbers and figures. I don't know how much cash flow you need, what capital growth you're looking for, what you're trying to achieve, whether your current investments should be kept or sold. So rather than giving you general advice like this, I'd recommend having a chat with one of the wealth strategists at Metropole and letting us run the numbers on our very sophisticated software to help you understand what the real cost is, and interestingly, what the cost of getting out is, because there are costs in that as well. Thanks for the question, Brett.
Yeah, huge costs. Ken, this is one I get quite often.
Probably I'll just add two things onto that. Just keep in mind that the different buying entity that you use will greatly impact your land tax. And also look out for that land tax assessment to make sure they've done it correctly. And there is an objection if you think that they've overestimated the land value. So keep those two things in mind.
Thank you, Ken. This is a question, Ken, I get asked a lot from Andy F. My properties are owned in my own name. I want to pass them on to my kids now rather than them waiting until I fall off the perch. What's the most tax-effective way to do this?
Set it up correctly in the first place. Sorry about that cheeky response. I know it's a very valid question. Look, there's not much you can do because changing titles triggers capital gains tax. It certainly triggers stamp duty, and as a gift or inheritance, depending on what you're trying to do, that could close the door on that child's capacity to get first home owners grants and things of that nature. So there's one thing that you want to give them an asset. It's what are they going to do with it? And if you focus on more what are they going to do with it, because there are different strategies to achieve that same outcome. So you might use that property as security for them to get a loan, just as an example. So you've got to be very careful. Set it up correctly. If it was set up correctly in the right structure, you can move the asset before death, but that means you would have had to do it before you bought it. And there's also different strategies you can use on death to pass that on so that it remains in the family, as opposed to it goes to one of your children who might go through a divorce and then it goes to the outlaws, so to speak. So you've got to be careful on pre-death and post-death.
Okay, I'm going to throw one at you, Brett. There's a question from Ton who asked, Well, his words were using equity in your primary investment property to buy the next property. So I assume what you're asking, Ton, is how do I use equity in my home? You've given an example here, but you're saying the banks, despite you having a lot of equity, aren't going to lend you a lot because you don't have serviceability at the moment. Brett.
Yeah, we get caught out a bit here, don't we? Probably, what was it, 10, 15 years ago, probably when the last GFC was probably that time, you could probably go to the bank with a fair chunk of equity and take most of that and put it into another property, not worrying too much about serviceability. But the big factor now is serviceability. APRA's cracked down. There's a lot of things. So you've got to have the serviceability to do that. But that also is really, really important. It explains why you have to get that first investment property right, because too many people think, if I go for cash flow, I'll be able to get the next one quicker and things like that as well. But the most important and the best investment property you can buy is the one that gets you into the next one faster. And that's always capital growth. It's always the growth, the compound, the leverage. And particularly with what we're seeing at the moment, guys, around the country, that also leads to strong rental growth. We've got some significant housing shortages at the moment. There's an inherent undersupply of properties for as well. And I suspect you probably see rents are going to grow 7 to 10% per annum for the next probably 4 to 5 years. And if you've got that capital growth combined with that kind of growth, I think that's the best opportunity you can. So getting the right location is going to be critical for Tony or Tom. Back to Michael, aren't we?
Back to Michael.
We've had the land tax. Michael, I'm a 51-year-old. I'm a rentvestor who just bought my first investment property, which I'm starting to renovate. That's an existing dwelling and subdividing the block. How many years will it take to become truly financially free through property? And that's from Despina.
Despina, you're not going to like what I tell you, because I know on the internet there are people who tell you can get financially independent in 5 years and 7 years. There are people who flipped hamburgers last year and now flipping properties. It's like selling tickets to a unicorn. You're not going to get it, but they'll take your money anyway. So well done on doing a renovation and a subdivision. As Ken explained a few minutes ago, though, you've got to be a bit careful with how you structure it. Are you going to keep both? Are you going to sell one? And you say you're a rentvestor. So what we do when we sit down and put a strategic plan together for clients is look at the end game. And I propose the end game for you should be you should eventually own your own home with no debt. When you stop having personal exertion income, you should have a property portfolio, and you're allowed to have a level of debt on that. But you're also going to need things that bring in cash, and whether it's shares, ETFs, a commercial property, I'm not sure. But if anyone tells you property only, or shares only, or whatever, run away very quickly, because you are going to need things that bring cash flow as well. So what we do with our very powerful software is model it and see how long it's going to take, and also if you're not going to get there in the timeframes, what you can do to speed it up. But in general, it takes 20 to 30 years of investing to get financial independence. And the part of the reason is for the first 5-10 years, most investors get it wrong. We hear over and over again that 50% of investors sell up in the first 5 years. We hear over and over again that 92% of investors never get past their first or second property. So you can't do what everyone else is doing. But if you can negate those mistakes at the beginning, if you can avoid those and miss the first 5-10 years where people are learning lessons and then eventually getting rid of some of the underperforming properties and then buying the right properties, if you can cut that out, you can get there a little bit quicker. So well done on now renovating and subdividing, but I don't know where you've done that. You haven't left which state you're in, not even which suburb. So you've got to do it in the right location. As Brett said a while ago, your first property should be the stepping stone to the next one and the next one. So I think, unfortunately, it'll take longer than you would hope, but the end result's worth it, so don't give up.
I think there's some good news and some bad news there, Michael, we always say. The good news is she's actually probably got enough time there, right? She's probably got another property cycle or two. The bad news is she just can't afford to get it wrong. So there's been potentially the opportunity to catch up with someone who can kind of fast track that and, as Michael said, map all that out may really work well for you.
Now, I can see lots of questions in the Q&A and the chat sections. Guys, keep asking those because we will specifically answer as many of those as we can.
Thank you. Ken, another one for you. From Rodney J. I have 2 properties that I want to sell when I retire, which will be in about 6 years. What is my best outcome in regards to capital gains tax? And should I sell one property 1 year and the second property the following year to make it more efficient?
So the first thing I'd be looking at is why you're going to sell. Do you need to? Selling it in 2 different income tax years after you've retired then spreads out that tax burden. So just be very careful if one of them is at a loss and one is at a gain. You want to sell the one at a loss first because you can carry forward that loss into another year. The other thing you've got to be very careful is the way it's been financed. They cross-collateralized. If you sell one, are you actually going to be able to pull much money out, or is that going to go against the loans for the second property? So I would like to just know a little bit more, but in general terms, try and spread it to get into 2 different tax years. There's different things you can do to reduce that capital gain tax, not the capital gain. So hopefully you make the capital gain. There are different strategies. And again, this is general advice, not specific advice, but we see a lot of clients contributing more into super, which therefore reduces that taxable income that they've made in their personal name and actually transfers funds into super, which is a tax-free environment in retirement. So keep those strategies at the forefront, get specific advice to see how it works for you. And we just did something for a client only a couple of weeks ago. We did that 5-year catch up on the super. So there was a very large amount that could have gone into super because they were only putting in the minimum for the last handful of years.
Okay, Brett, there's a question that was left when the Carla actually registered for the webinar, and she said there, I'd like to know which major city would be better choice to purchase a 1-bedroom unit at this current time. Thanks for your question, Carla.
Thanks, Carla. That's quite a specific question. I guess, why a 1-bedroom unit? Is that what you're focusing on? Is that a home you want to buy? I think a bit more information there would have been great. Love to get an idea of obviously your budget, what your end game is, and if it's an investment or a home. And I guess the property you're purchasing should be the manifestation of all that data and information, again, rather than just, I guess, guessing on where to put your money. Probably going to realise that that's not the right answer. But, there's certain cities, obviously, across the east. I probably wouldn't be looking at buying apartments in Brisbane. Probably Sydney or Melbourne would be ideal. But then again, like we spoke about, sometimes you can get a good house in Brisbane or a Melbourne property for the price of a 1-bedroom in Sydney. So probably a bit more information there is required. And it'll come back to what you can afford. And although units do have a land content as well, making sure you make the most of that is going to be really, really important. So again, Carla, if you did want to get specific and talk in more detail, then please make a time to talk with us.
Now, Ashley Zhang left a question in the chat, in the question and answer, Ashley. So thank you for coming online and listening and watching us. And I'm going to answer your question because you asked, are there any important criteria for an investment grade property? Because yes, we often talk about investment grade properties, and there are about 11 million dwellings in Australia at the moment. And according to CoreLogic, the total value of those is $10.7 trillion. But not all properties make good investments. So what makes an investment grade property for you, Ashley, may not be an investment grade property for me because I'm at a different level of my game, or Ken or Brett, who are different as well. We're playing different games. There's a severe shortage of investment grade properties on the market at the moment. At Metropole, we're much, much more than a buyer's agent. We actually help our clients strategically plan and build intergeneration wealth safely and outperform the markets. But we then, after doing the plan, our buyer's agent team help our clients purchase property. And at the moment, there's a real shortage of those. And so our buyer's agents are finding difficulty. And I'll explain the answer in just a minute. I'll give you a bit more clarity. But only yesterday, Brett, there was a great villa unit in Melbourne that we thought we offered a very fair price on, and somebody offered 7% more, because it was, I guess, such a great property. And we said to our client, sorry, sometimes people are either, I don't know, smarter than us or dumber than us and will be prepared to pay more. But there is a flight to quality, and there is a depth in the market at the moment of investors. In fact, the investor finance has increased 31% over the last 12 months. But To answer your question about investment grade, as an investor, you make your money in 4 ways: capital growth, rental returns, accelerated growth, forced growth, manufactured growth, like the person we spoke to a moment ago who's doing some renovations, and also tax benefits. But to us, capital growth is the most important driver of wealth creation. More than cash flow. Cash flow keeps you in the game. And yes, you do need financial buffers that'll see you through the lean times. But it's the capital growth, because capital growth properties end up giving more rental growth as well. And property investment's a game of finance, and with some houses thrown in the middle. So it's not just finding an investment grade property, but getting the right structures and getting the right finance. And for many beginning investors, they're just looking for cash flow properties when they really need to build an asset base, because once you've got a big asset base, you can buy all the cash flow you want. So to me, capital growth is the most important factor when looking for an investment grade property. Well, it depends where you are at the stage of your life, your career. So if you're at the asset accumulation stage, you need to buy asset growth. And that means the right location. Location will do 80% of the heavy lifting. And what a lot of people are talking about on the internet at the moment is past records, data. We've got access to all the data. We'll tell you what all the data. We've got all the data too on 15,000 suburbs going back to 1984. That's as far back as the suburb-based data does. But that's looking in the rear vision mirror. So at Metropole, what we do is look forward to looking for areas where there's going to be economic growth, but economic growth where there's higher paid jobs growth, which is going to lead to population growth, which is going to lead to people who can afford to and prepared to pay more in rent or to live there. Not all properties are investment grade, so high-rise dwellings tend to not to be, new house and land packages tend not to be, because they don't have any scarcity. So really what you need is the sort of property that's got strong owner-occupier appeal, a high-ish land to value ratio. Apartments have a land component as well, as Brett said a moment ago, a level of scarcity, the right orientation, and a wide appeal. And I also like properties that have got the ability to add value. So there's quite a lot that goes into deciding what's an investment grade property. Thanks for your question.
That's another webinar, Michael, isn't it? There's that many
on its own, that's right.
I'm happy to take this next one from Gag, and in the Q&A, he's just asking about being new to real estate, doesn't know the ABC of property. Please let me know some information or tips to follow. Gag and I found myself in that situation probably about nearly 20 years ago now, and I don't think you do anything worse than probably have a listen to Michael's podcast. Jump on Property Update, where there's a section where you can actually start from the beginning and learn the ropes from the start. And certainly with 9 books under his belt, Michael, I think my favourite book was How to Grow a Multi-Million-Dollar Property Portfolio. It's probably one of the only property books that have stood the test of time, and it was certainly my Bible. So, Gagan, I think that would be a fantastic place to start with the podcast and the books and Property Update.
And the Property Update, you'll see an online store. You can get the book, or you can get it on Kindle. It's on the bookshelf of every successful property investor in Australia. It's had its 16th edition, so we've updated it over time. So that's a great place to start. Thanks, Brett.
No problems, Ken. A question from Alison Barrow here is: I've topped my investment mortgage. Is paying the interest on my mortgage that comes from my loan, not my income, a tax deduction?
You've got to match income and expenses. If you have an investment loan, the interest is certainly deductible. One of the mistakes we see a lot of people make is the loan is in a different name to the ownership of the investment, and they're potentially losing out on claiming interest. Another area we see where the ATO has some difficulty is when people are drawing money, call it from their home loan for the deposit, and their home is in 2 people's name as an example. They buy an investment, they get a loan in one spouse's name. Again, you're potentially sterilising the amount you can claim, but all is not lost. There is paperwork you can put in place to actually give you the full tax deductibility of what you should be getting.
Now, I'm going to give a shameless plug, if I may, Brett, because at the moment we're going to answer as many of your questions as we can. But again, just to be clear, this is not specific advice. And I hope you can see that we are able to help you with good general information now, but more specific information if we catch up with you face to face. So Brett didn't say at the beginning, put away your phones. Don't. Pull out your phones and scan this QR code and have a chat with one of our wealth strategists about your personal situation. It's complimentary. And in fact, I'm going to do something I haven't told them about, but I've got a special report that I've just updated and completed about who to ask for property advice. And it's got a lot of detail about that. So if you take the opportunity to have this complimentary chat with one of our wealth strategists, we'll give you this educational consumer guide about who to ask for property advice. So I'll make sure that they know about that. So if you just scan that and fill in your details, and we'll be in contact with you. And again, the report is a nice little, let's call it ethical bribe. The most invaluable information is that you're going to have a chance to pick their brains, and we've got no properties to sell. What we're going to do is, if you have a need, help you plan to become the person you plan to become. Brett, any more questions?
Plenty of questions here. We're starting to get a little bit specific here, Michael, but Davo has got a property in New South Wales. He's also got a property in Queensland. He's wanting to decide whether to buy another one in Adelaide or another one in Brisbane. His budget is around $600,000. What are your thoughts?
So your budget's going to make a difference. Again, as Brett said, the property you eventually buy should be the physical manifestation of a whole lot of decisions you make. But your question doesn't surprise me, because the most common questions we're asked are, where should I buy? What should I buy? And to be blunt, the other question people ask is, what are your fees? Now, again, the most expensive advice you can get is free advice from the internet that gives you the wrong answer. And probably the cheapest advice you can get is the one that makes you the wealthiest. So forget the fees bit. The next question is that what should I buy, or where should I buy? Again, we're all playing different games. I don't know at what level of your journey you're at the moment. Your budget means that you're going to be restricted from, you could buy a double garage in Sydney, but I'm not sure that that's a good investment. Actually, it probably is, Brett, because they've gone up in value a lot too, but the bank may not lend you enough for that. So there are some really good investment opportunities still in Melbourne, which hasn't risen in value, like we said right at the beginning of this webinar. And I know we've bought a couple of homes for clients in Melbourne in that price bracket, in some good middle outer suburbs, but gentrifying suburbs where young millennials are moving to. A couple of years ago, we would have said Brisbane, Brett, but what can you buy in Brisbane at that price? You can still buy a townhouse in a good location or an apartment. So there are options, but what we've got to understand is blending your cash flow requirements to service the loan together with the capital growth requirements, and then find the sort of property that's going to outperform. I think, considering your budget, the right sort of property in Melbourne could easily be what we call a villa unit, which has its own land component and still appeals to young families, because they don't have to go up and down stairs, older people, owner-occupiers, and also tenants. Thanks, Brett.
I also probably want to understand his existing properties too, Michael, because sometimes you might have a property there, like every property's gone up in value over the last 3 or 4 years, but is it going to go up in value over the next 5 and 10? If it is, hold it. If it's not, then maybe you could move that property on at a time when you've made some money and replace it with your bigger budget, and now you're getting into a bigger and a better property. And I think Melbourne's probably a good call there in terms of considering that as an option as well, given that Brisbane and Adelaide are very much at the top of the cycle. But
yes,
so some choice there. Ken, there's one here from Mike Barbera. I had an owner-occupied property in Melbourne that I recently turned into an investment property. When should I start paying land tax? Nobody has reached out to me.
So land tax is self-assessed. You've got to fill in a land tax registration and submit it to the various state governments. Each state government has got a land tax-free amount. So the problem is they may not know that you've actually moved out of the property as a home into an investment property, so they don't know to send you a bill every year. So the first thing I would do is look up what for that state the land tax threshold amount is. A good way to have an idea of the land value that you would be assessed on is to go to your last rates notice. Now, your rates notice will tell you the value this year, whereas land tax is calculated on the average of the last 3 years. So normally the average of the last 3 is lower than the current year, but that'll give you a bit of an idea. And if you are in a land tax paying situation, I would quickly register for land tax and therefore not get a surprise in a few years' time where you owe 4 or 5 years worth.
They don't
Plus
forget
penalties.
They don't forget, do they?
They finally get you. And one of the things, just to frighten you a bit more, is the ATO is spending billions of dollars on their IT system. And in your tax return, you'll have a line rental income. That will eventually find its way into the state government, and they'll say, rental income on this address. Oh, hang on, I thought that was the home.
Yeah.
So they're getting cleverer and cleverer in finally catching up with you.
Their data matching service works very well. Now, there's a question in the Q&A. Thank you, Lynn, who's asked a question. Do you consider a 3-bedroom property in Kingsford and Kensington in Sydney investment-grade locations? The answer is yes, they're both investment-grade suburbs, but not every property in that suburb is an investment-grade property. And genuinely 4 days ago, believe it or not, my postman's wife asked me a question. The gentleman who got to know us over COVID by dropping all the parcels, over COVID, Brett, in Melbourne, when we were locked down for 260 days, there were 2 sorts of days in Melbourne. The days the parcels that you bought online were delivered, and boy, I got to know our postman very well. And the other days were the days you threw out the stuff you bought online that you didn't really need. But interestingly, she found my book, How to Grow a Multi-Million-Dollar Property Portfolio, and he actually said, because he saw the name, Michael, and I gave him another book, but only on Sunday, they told me that they'd read my blogs, listened to Property Update, read Property Update blogs, listened to my podcast, and found a suburb in Melbourne that they bought a property in because Michael said it's a good suburb. Now, I may have mentioned the suburb, but they bought on a main road, 4 doors from a main shopping centre, which is right on the corner of a Nepean highway. So is it a good suburb? Yes. Was that an investment-grade property? Now, it was for their home, and they had to start, and people live everywhere. And during property booms, everything sells, even on main roads. But if you're looking for an investment-grade property, Lynn, and during this time, everything's leasing, but the cycle will move on. And so if it's not in the top location in those suburbs, the answer is it's not an investment-grade property. And if you're talking about a home, that's quite expensive there, and nothing wrong with that. There'll always be demand from owner-occupiers, but it's got to fit into the streetscape. It's got to be the right street. And in Sydney, it's even got to be the right side of the street and in the right orientation. I used to jokingly say in Sydney, there are some houses that have magnificent views of the Sydney Harbour and the bridge, and other houses on the other side of the street that have magnificent views of the houses that got magnificent views of the harbour and bridge. So good suburbs, not every area in that suburb, and definitely not every property in that suburb. You've got to understand why some properties are more in demand by owner-occupiers that are the big purchasers of property. And so at Metropole, and I keep plugging Metropole, but please excuse me, but our buyers agents in Sydney are ex-estate agents who know why some things sit and some things don't sell while others do. So you need on-the-ground experience and knowledge, the stuff that you can't get from a database or a spreadsheet.
Yeah, well said. Ken, Anand has asked, is it best practice to buy a different property in a different entity every time?
I answer that based on asking 2 questions. And you really need to prioritise or maybe three questions. The first one is asset protection. So the more properties you have in the same trust, if something happens with one tenant, it's a domino effect and it could impact your wealth of all the properties. The second question I ask is in relation to land tax. So is your land tax reduced if you use multiple structures? And in some states, Queensland as an example, it definitely would. And depending on the structure you would use in New South Wales, it would. And different structures could even help you in Victoria. So land tax is the second question. And the third one is, I mean, at the end of the day, the KISS principle, keep it simple. Some people like to minimize, their admin, their accounting fees. But if you make substantially more out of managing your assets than those admin fees, we should just treat the admin fees as a cost of doing business.
Now, Brett, I'm going to ask you a combination of questions that people asked when they registered for the webinar, because the answer, I think, in many cases will be much the same. Julian asked, is it a good time to buy or sell? Lizzie asked, do you advise people to purchase property in Brisbane? Fahad asked, is the high price of properties and interest rates now the wrong time to invest in high-value properties in Western Australia? And Radhika asked, which suburbs and cities and suburbs, are the best option, and how do you lower your tax rate? Well, let's leave the tax rate one out, but all the others are talking about timing and buy or sell and where.
Yeah, again, they probably would love to know the specific information for people and things like that as well, depending on what area and what location you're in, what time of your investment journey you're in as well. Look, I think the fundamentals are reasonably positive at the moment, depending on where you're selling. I think Western Australia may be the right time to consider selling. I mean, we're at the top of the cycle there, so if you did want to sell at some stage, it's probably going to be in the next 12 months. I do think we will get an interest rate cut at some stage, probably next year. So there's probably a little bit of life left in all markets at the moment, I think. So maybe hanging out for that at some stage next year. But it's really down to your personal circumstances. It's nobody can tell you what's going to happen next. So it's just making sure that you make those longer term decisions with as much information as you can.
I think that's a really good point, Brett, that you say it is so much personal. It actually has a lot to do with your aims, your goals, your cash flow, your risk profile, what you already own. Do you have a home? What you're planning to do? And so therefore, people who tell you, I have found a location, I have found the right hotspot, I have found the next right place to buy, and not taking into account your circumstances. And what that ends up meaning is that they've usually got a vested interest, a stock list to sell from or something like that. So be very careful whose advice you take in that regard.
Yeah, Michael, my wife's favourite TV show's back on, The Block.
It started again. I didn't know.
Yeah. It's on again, and a suitable question from Carmela. Maybe she's a Block fan as well, but she's asking, she's saying that a financial advisor told her not to consider renovating and flipping because the tax projects and CGT and all those other things make a profit quite difficult. What's your advice on this?
Okay. Well, interestingly, your financial advisor gave you the right idea, Carmela. Let me explain that renovation and adding value is a great way of increasing the capital value of your property, if you do it right, and increasing your rent and making it more suitable to a wider range of tenants, more appealing, so they'll pay more rent, you'll rent it quicker. But if you were to sell, if you were to flip, you end up paying capital gains tax, some CGST, the agent's commission, tax on the profit. And I said capital gains tax, and I apologise, I was wrong, and Ken was courteous not correcting me, because in fact it's a trading endeavour, so you don't get the capital gains tax exemption from it because it's a business venture. On the other hand, if you use our brewer strategy, buy, renovate, refinance, and repeat the whole story again, it's a better way of doing things. There's not enough markup, there's not enough margin in renovations and flipping. Now, major structural renovations, which take longer, need council approval, like adding another bedroom or two, or that could create significant value. But interestingly, a number of years ago, I went to the block auction on behalf of a client. We didn't get the property, but I actually saw the numbers and figures, and I saw the quantity surveyor figures that they were giving out as part of the information package for potential purchasers. And there was no way they made any money out of the block. The quantity surveyor figures showed how much the renovations cost, and the real true cost of the property, despite the fact that a lot of the materials were actually given to them by sponsors, was significantly more than the end value of the property. And the only reason those properties are selling on the block and making money is because of one or two interesting buyers. And Danny, the bidder, was there standing next to me at that particular auction where he was making all those silly bids. But if it went to the proper market, they wouldn't even make any profit out of the block. So it's a very profitable show for the Channel 9 and the network and the advertisers, but flips usually flop. Carmela, your advisor gave you good advice.
Absolutely. Thank you, Michael. I appreciate that. Maybe one more for Ken before we start to wrap up. Ken, just over 60 now. We're retired. We've got a property portfolio. It's doing quite well. The LVR is about 25%. All the loans are P&I, and it's positively geared. To fund our retirement down the track, we may want to refinance rather than sell. What's your experience with regards to banks doing this? From Fran.
Good question, Fran. And I think, as we mentioned a couple of times during the session today, is serviceability is how a bank determines borrowing. You've got to have the serviceability. So are the properties generating enough income to cover the increased loan? Do you have other investments that are going to create income? How much do you have in your super fund that would generate income? And in pension stage, it would be tax-free. So I think in retirement, reducing your debt as much as possible is a good strategy for any number of reasons. Obviously, there's the principal component, which eats into your cash flow because it's after-tax money, whereas the interest is tax deductible. But what we've found over the last couple of years at Metropole is people like yourself, Fran, where they're moving into retirement. It's that end game. We call it the end game, where they've got properties, they've got super. They don't know how it's all going to come together. And the issue that we found is it's really three different professionals coming in. What do I do with my properties? Is the property people, the financial planner, and then the wealth strategist that talks about the tax, the estate planning. So what I'd be doing is making sure I cover all those bases. I know I've answered a bit more than just your question about what the banks will look at it, but keep those other areas in mind, because you're going to have to show the bank that if they give you a 30-year loan, and people say, oh, banks don't give loans for 60-year-olds. Well, I don't know if we're doing audio and visual, but I could say you're looking at somebody where the banks did lend and gave me a 30-year loan. So statistically, I'm well and truly underground. A good broker could identify an exit strategy that would allow those banks to recoup their loans in the event of death. So that's going to be a main component of the finance strategy. So you've got to go to a very competent finance strategist as opposed to just going to the general person in the bank.
Now, Brett, I'm going to once again suggest that if people want to understand more about their own personal circumstances, just pull out your phone, scan this, and leave us your details. Remember, if you have the strategic wealth chat with our wealth planner, I've got that special report that only 10 days ago I've completed and totally updated. So how to choose a property advisor. And it's got lots of advice about the different ways people get information about property investment or home buying. Just organise a time to catch up with one of our wealth strategists. And Brett, we've got 4 minutes. So I'm going to try doing something which is a real quick run through, answering a couple of really quick questions there. Anna asked, I have a problematic property manager and useless strata manager. What do I do about this? You are allowed to change your property manager. Yes, it's a very difficult task at the moment with the continual changes of legislation. But just like every other profession, there are some that are better than others. I don't know where your property is. In Melbourne, Sydney and Brisbane, Metropole specialise in property management. Most estate agents specialise in selling property, and property management is a side business. For us, it's the major part of our business. We look after close to $2 billion worth of assets for clients. So if we can help you scan that code and leave a message there also. Strata managers are much harder to change, but the strata committee, get on the committee of your strata property, and you're definitely allowed to change those as well. I'm wondering what's the best to sell a property to a developer, I'm wondering whether it's best to sell the property to a developer or sell it as a new duplex. And this is somebody who's got a 1/4 acre of land, Camilla, and I'm sorry, I don't know where your property is. Developers currently are very cautious about buying properties. And if it's a 1/4 acre of land, it's probably only a 2-unit site. So I guess the answer is, at the moment, 1 and 1 doesn't equal 2.5 anymore. So even if you have development approval, there's actually very little margin in developments at the moment. So if you and if you've never done a development, and if you don't know what you're doing, if you're asking this question, I would believe that you're a beginner in the development stage. Be very careful what you're doing. Having said that, in both Melbourne and Brisbane, we have development project management services that help clients become what I call armchair developers, and we run the whole project from concept to completion. So if your site is in one of those states, Melbourne or Brisbane, again, scan the QR code and have a chat with one of our wealth strategists. I think, Brett, we've really got to finish up unless there's any other quick questions that you've got there. But we'll have to.
I can see 2 quick ones, Michael. But maybe 2 quick ones, maybe one-word answers for all of us. When will interest rates come down?
Oh, good. Okay. The property money market, not the property market, the money market, the big money believes interest rates are going to fall at the end of this year and fall 3 times into next year. The money market is all the big institutions who are hedging their money. The Commonwealth Bank and Westpac believe the first interest rate fall will be in November this year. The ANZ Bank believes in February, and National Australia Bank's the most pessimistic, suggesting that interest rates are going to fall in May next year. The Reserve Bank has told us, no, we're not going to drop interest rates this side of Christmas, but they're not going to signal that they're about to drop rates, because that's going to only encourage people to spend, which will have the opposite effect of what they want. I think early next year.
I agree. I think March, April next year. Yeah.
I think a bit later than most of us would like.
Yes, unfortunately, that's right. You said there's 2 more questions, Brett. One more?
Oh, there is one more. The next place to boom. I know what you're going to say, Michael.
Well, Melbourne's not going to boom. Melbourne's going to grow and grow well. But in fact, I don't like booms, because booms usually lead to the next downturn. Perth has boomed because it hasn't done anything for a decade. So it's really a form of catch-up. I don't look for the next boom areas. I look for areas that are going to be less volatile, because it's easier on your budget, it's easier for planning. And rather than looking for an area to boom, I would be manufacturing capital growth through renovations, development, smart negotiation, finding the right sort of property off market. That's what we specialise in at Metropole.
I think you're right there. I think every other capital and place in Australia has gone up in value, so Melbourne has to at some stage. I agree.
Now, I do want to throw one more, because Frank Artega, who's a good old client, has asked, and you're not that old, Frank, I'm sorry, but I haven't seen you personally for a while. What's the process, Ken, of transferring a residential property from an SMSF to a beneficiary as a species lump sum, assuming the beneficiary is retired? Will this be a complex process? What should you watch out for? Frank, this is not specific SMSS advice. So forget that I asked a question about a particular person in Melbourne. Ken, general information, please.
generally. So you can transfer a property from your SMSF to an individual. You can't go the other way, of course, but you can only go from the SMSF. And it will trigger capital gains tax. So if you're in pension stage, then there's no tax. And if you, the buyer, then has to pay stamp duty. There's potentially those two taxes. In specie means I'm not going to sell it and take the cash and give to the person. In specie means I'm going to transfer the physical asset to give to the person. But same taxes that would apply had you sold it and moved the money, other than the stamp duty on the buyer.
All right. Thank you, gents. Thank you very much. Hopefully that was very informative. I think we got through a fair few questions there, particularly good to have some from the live audience as well as the pre-prepared questions that we've had. There's probably a few questions left over that can probably perform part of the next one as well. Michael, anything to finish off with?
No, thank you for giving up your time. I can see that most people stayed for the whole webinar. We're going to send you links to the replay if you need to do this, and it'll be replayed on the Michael Yardney podcast. Maybe I should just give a quick plug for my new podcast with Simon Kirstenmacher.
Yeah.
Once a week, every Wednesday, we're running Demographics Decoded. At the time we recorded this, it's day 2 after our first show yesterday, and it's already ranking number 7 in Apple Podcasts in business. Simon and I are very proud of that. Simon brings great information so we can unveil the trends that are going to shape your future. So go to either YouTube, where it's a video podcast, or in any podcast app, Demographics Decoded. Look for that, and once a week you can listen to that as well as the Michael Yardney podcast. Thanks for the opportunity of sharing that, Brett.
Thanks, guys. Thanks, Ken.
Thanks, everyone.
Thank you for spending the last little while with me. I hope you got some benefit from this show. Hey, but before you move on to the next podcast you're hoping to listen to, please let me remind you that I have another show that I produce once a week with leading demographer Simon Kirstenmacher that we call Demographics Decoded, where we unveil the trends that are going to shape your future. This is a must-listen to podcast for anyone interested in property investment, business, or entrepreneurship. So if you don't currently subscribe to Demographics Decoded, please stop for a second, subscribe on your favourite podcast app or on YouTube. Now, if you did enjoy today's show and you know somebody else who'd benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just talk to them, tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour. You're definitely going to be doing me a favour in helping in my quest to make as many people as possible financially literate. Now, you can catch up with me in between these shows on social media, or you can join my private Facebook group. Just go to Facebook and look for the Property Update Facebook group. And I've got a special bonus for you to say thank you for subscribing. Just go to podcastbonus.com.au. There's a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. That's my way of saying thank you to you for taking the time to listen. Oh, by the way, if you haven't listened to the many podcast episodes we've already got, we're well into our 600s of episodes now. You can always listen to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?